Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we always do. I'm going to share my opinions going through it. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to go right in, dive right in, see what people are sharing. If you want to follow me at Finance, and if you want to join our community, finding-value.com, that's where I'm playing these big cycles, looking at investment opportunities for the next commodity bull market that we're in, and then investing in those opportunities. You can see all of my movements and see what I'm buying, how I'm doing it. And if that interests you, we have a special coupon code. It is special. That's the coupon code that you type in, and it gives you a discount on monthly and yearly memberships. Description link below for those deals. So we've got Ayn Rand. Ayn Rand, I've watched her work. I've read some of her work. I think she's probably one of the smartest people I have ever listened to on a lot of topics. She's very out there in terms of her ideas and thoughts. And I agree with a lot of what she has to say. So here's a couple of quotes. It says, if before undertaking some action you must obtain the permission of society, you are not free. Whether such permission is granted to you or not, only a slave acts on permission. A permission is not a right. That's like getting permits and all this other crap. We need to get rid of it if you really want to go to the extreme. It says, when you see that in order to produce, you need to obtain permission from men who produce nothing. When you see that money is flowing to those who deal not in goods, but in favors. When you see that men get richer by graft and by pull than by work, and your laws don't protect you against them, but protect them against you. When you see corruption being rewarded and honesty being a self-sacrifice, you may know that your society is doomed. Ayn Rand. Does that sound familiar at all? Now, how can we get out of the clutches of these people? Federal Reserve's a big cornerstone of that. Federal Reserve's a big cornerstone of that. And that's one of the things where they basically pillage the currency and then they tax you through inflation. And they can do that because we don't have a gold-backed currency. And in the Constitution, one of the ways that they block that is from gold and silver. That is how they block these grifters from stealing all of our crap. So that's the main deal there to prevent from being stolen from is through your currency. And fiat currency opens the door for all sorts of illegal activities, is what I'll call it. And you could even say that some institutions are illegal institutions. Moving on down, Christine Guerrero. Wow, the greed is strong with the steel guys. Keep an eye on shale well costs. U.S. oil will be seeking such an exemption. And this is U.S. steelmakers urge Trump to resist metal tariff exemptions. These tariffs tie into Ayn Rand. You want to be able to trade freely between countries, in my opinion. So I'm not a pro-tariff guy. I'm also anti-taxes. Every single tax must be taken or stolen from someone else. So when people get to vote, the original system, I mean, just to sum this up, the original system had limitations on who could vote, and they had limitations on money, which they blocked through gold and silver. Now we have no limitations. So people are literally voting private property away from other people. So you either have to limit who can vote, like maybe people who pay taxes, and then the strength of those taxes is the amount of voting power that those people have, or you block the currency, or you do both. They had both in the original design. The design doesn't work when you aren't using those pieces of the original design. Now it's just a free-for-all. They can print money, steal private property, do whatever the heck they want. It's kind of a free-for-all, in my opinion. It says, I'm still searching for the oil glut that I keep hearing about. He's going to be searching for a long time because we've got a supply problem, not a glut. We are very low in supply. I'm going to talk a little bit about production and supply with Christine Guerrero. I think she's right, and she makes an accurate statement. And I'll obviously share my opinions there. But you can't be in a glut if you are low on inventory. Now, some people will say, oh, you've got all this spare capacity. Yeah, where, bud? Show me where. And tell me where all of this spare is that's just flowing into the market. And if we have so much flowing into the market, why isn't it showing up in inventories? Because it's not there. It doesn't exist. Now, there is spare capacity. The question is just how much. I'm in the camp that it's much tighter than what people think. I've heard numbers thrown out of 6 million barrels, and there's no way we have 6 million barrels of spare capacity that we could lean on consistently. Now, there's surge capacity where you start to destroy your wells, and then there's stable capacity, which your stable capacity, you might only have 1 million barrels left. And we'll get to it again. Here's Dan. He says, positive for the Canadian medium sour oil if U.S. moves to fill the SPR with Canadian oil. It says, to get back to full levels like 12/31/2010, we would need to add 150 million barrels of sweet crude and 182 million barrels of medium sour. U.S. doesn't produce medium sour, so we would need to look to Canada and others for the 182 million barrels of medium sour. That's going to take a long time. Now, here's the problem. Here's the big problem here. If they try to fill the Strategic Petroleum Reserve and we get under 1 million barrels per day of spare capacity, there's no way they're going to be able to fill that up. I mean, there's no way. They're going to send the price to the moon because there's no way that they're going to, you're basically sucking up all of the spare capacity. So how are they going to do this? Well, you could engineer a recession and then fill it up during the recession where you do a lockdown, you kill demand, you do all those things. That is a possibility. Maybe that's what they're setting up for. That very well could be. And here's another ironic thing. We need to get all of our medium sour from Canada. Yeah, let's go throw a bunch of tariffs on them. And then we can fill up our Strategic Petroleum Reserve after we put tariffs on the medium crude there. Yeah, that's great. And they'll probably back out. They'll be like, no, it doesn't include crude. We need to fill up our SPR. And then maybe after we fill it up, maybe. Christine Guerrero says, U.S. estimates it will take 20 billion and years to refill the oil reserve. No official request has been made to Congress. That's how long. It's going to take a long time to fill this bad boy up. And you know what? Oil prices generally go up when they fill this thing back up. But if they create a demand destruction event, I mean, maybe they could fill it up on the cheap. I don't know. If they do that, so here's another thing. Here's more evidence. So you guys, I know, some of the viewers, they don't think ahead maybe as much. They just look at price and then they determine their narrative from prices moving up and down. A bunch of NASCAR guys, right? A bunch of NASCAR guys used to go left, but if you make a right, no, it explodes their brain. But if we get a demand destruction event, and if they fill up the petroleum strategic reserve, tell me that it wasn't planned. Tell me that it wasn't planned. Coming down. Christine said, so far, no seasonal pickup in rigs. Drill baby drill is dead in this priced environment. If rigs stay here, the U.S. would be in short cycle production decline. Now, here's a real problem. If they try to push the oil price down through paper barrels, and if they're successful at doing it, they're going to create a massive oil price spike. Then the question becomes, are they doing it on purpose? Are they creating a spike on purpose? I don't know, but just something to ponder. JSG says if we look at the OPEC Plus decision to bring back barrels through the lens of inventory data, the decision makes sense. We just can't get behind it because of the current price. Per EIA, global liquid inventories are the lowest they've been since February 13th. Brent was trading at $110 back then. This doesn't add up, guys. We've got 110 per barrel in February 13, and that's when the inventory level was trading where we are today. But to take it a step further, our days of coverage of inventory is far less today than what it was in 2013 because our 2013 demand was much lower than it is today. So my question then becomes, what is going on here? What is going on? And I hate to say it, but I think Saudi's bringing barrels back on because we're going to get real tight here. And this is going to create a slingshot to the upside. Man, is somebody going to get a bunch of ick on their face when this blows up on them? SPR, it's urgent to refill it, but there's a limit to how fast it can be refilled. The Strategic Petroleum Reserve can discharge oil quickly, but filling it up takes more time. It's 5, 6, 7 years to get the Strategic Petroleum Reserve back to full. But we're dead set on doing just that, says U.S. Energy Chris Wright. Good luck on that. This is going to take some time, guys. And if the market squeezes on them, I don't know if they have the chance to do it. They're going to... If the market squeezes on them, let's say we get to 120, 130, 140 a barrel, are they going to buy back into the Strategic Petroleum Reserve? And what if that spare capacity isn't coming back? What if we lose spare capacity and we can never regain it back? What does that world look like? And we've been using 3 to 5 barrels of oil for every discovery that we found. Back when we hit conventional oil peak in the mid-2000s, we knew that shale oil existed. What they were working on was figuring out how to extract from shale. Once they figured out the technology to basically extract shale, that whole reserve kind of opened up. Now we're kind of looking at it, it's like, where are we going to get all this other oil and how much flow can we get from it? And that's a huge question mark. So in the mid-2000s, we knew where oil was at. We just had to figure out how to get it. If we hit a problem in spare capacity over the next couple years, I'm not sure if we've got a bunch of oil just sitting there waiting somewhere in the world that we just haven't drilled and we're waiting on the technology to get it. Maybe there is, maybe there isn't. I don't know. That's what we're gonna find out here in the next few years. Obviously, I'm an oil bull because of that situation that we're in. Another thing that people are underestimating is the problem that we are in with our financial debt in America. If the debt has to go up in order for the design of the system to survive, it's going to put a lot of pressure on oil to increase production. And the problem is that scenario. It's an increase of credit creation against a problematic supply increase. And if you run up your credit creation at a faster pace than supply, you're basically running it at a faster pace than GDP can keep up. Because GDP is oil supply. And that's going to be highly inflationary if you moon oil. At the same time, they're trying to fill up the Strategic Petroleum Reserve. Good luck. Good luck. You're in a really weird position here with trying to do all this. Christine says, got an email from Australia this AM regarding the great OPEC spare capacity debate. I think the biggest issue is that the market doesn't understand how it's being defined by individual countries, but here's how she perceives it. Spare capacity is a combination of these 6 things. The physical limits of producing wells, the capacity of gas and oil separation plants, the capacity of water injection, the reservoir balance system, and 4 is the maximum capacity of pipelines. This is the other 2, which are also dependent on geophysical limits and safe or best practice depletion rates to keep the reservoirs from being damaged, time-limited maximums. And then we've got 6, the market, which equals supply and demand balance limits for each grade of crude. So both UAE and KSA, the Saudi Arabia, have spent a lot of money in the last decade strengthening their oil supply systems. At the same time, for bullet 6, the market doesn't need it. It's easy for me to argue that the spare capacity is 5 or 6 million barrels per day based on points 1 through 4. But then you could argue that it's less than 1 million barrels per day based on points 5 and 6, which is geophysical limits and safe and best practice depletion rates, and the market supply-demand balance limits for each grade of crude. This is where there's a huge confusion in the market right now. I have heard many people quote that we've got spare capacity of 5 or 6 million barrels. I am in the camp that we are around 1. And the difference is this exact difference that I am looking at. I don't think the other people have any idea about this. Now, we have surge capacity, maybe up to 4 or 5 million. Now, when you surge it up, it's going to be limited and temporary. I think we've got about 1 million barrels long term. So I think we're skating on thin ice here, and something's gonna go down here. Freight futures, AM update. We've got dry bulk. Capesize is up 2%. Panamax is up 3%. Tankers, VLCC is up 3% with Suezmax flat. We've got global oil inventories are down 120 million barrels year over year. And that's kind of how I like seeing it. I like seeing the full amount year over year, 120 million barrels. That's a lot of oil. And again, it's easy to deplete this. It's going to be incredibly hard to refill the SPR and the commercial inventory levels. I mean, guys, I don't think people are thinking this through. If you get less than 1 million barrels of spare capacity and you are short, let's go back up here. You are short, what was it? You're short 332 million barrels. And then you're short in your commercial inventories of 120 million barrels. So you're 450 million barrels short oil. And you have a spare capacity of barely 1 million barrels per day. You're not filling these things back up. You're basically going to ignite an oil bull market that no one's ever seen in their life before. And we're coming right into it. Now, this is what they're going to do to handle it. This is my guess. When oil starts to move on up, they're going to throw us into a recession. That's what's going to happen. And then they can't print money. But if they print money, it's going to send this thing to the moon. The world has 120 million barrels less oil inventories than a year ago. Oh, yeah, that's another one I shared. The recent downturn in tech and consumer discretionary is on the verge of becoming systemic, spreading across other sectors in my view. Considering the significance of these sectors in the economy, I'd be very surprised if this doesn't eventually spill over into other parts of the market that have either held steady or remained positive for the year. At this point, the current administration has little choice but to orchestrate a sharp economic slowdown, both to pave the way for significantly lower interest rates and to pin the blame on the prior administration, given the short time since taking office. Is that what's going to happen? Are they going to do a short, sharp economic slowdown in the short term? It's kind of what the market's been pricing to some degree. And that could also allow them to get interest rates down and maybe roll over a bunch of debt and kind of push out into the future this oil problem that's in the background. And they could maybe fill up the strategic petroleum reserve. This is like 7 birds with one stone, or 7 birds with one pullback. Charlie Munger says, if you want to succeed in investments, start early and try hard and keep doing it. All success comes that way, by and large. And that's the last thing we're going to go over since a lot of people get confused. I don't know why they get confused, but I'm going to go over it real quick. I went into Grok 3, and I asked secular bull market versus a cyclical pullback. And I think a lot of people get very confused on the difference between these two. So let's go over it here real quick. A secular bull market is a long-term upward trend in asset prices, typically lasting years or even decades. It's driven by fundamental factors like sustained economic growth, technological innovation, or favorable demographics. Think of it as a big picture. Stocks, for instance, climbing steadily over time despite occasional dips. Historical examples include the post-World War II boom from the 40s to the 60s, or the tech-driven run from the 1980s to the late 90s. These periods aren't straight lines. There's volatility, but the trajectory is undeniably up, and I consider that to be higher high and higher lows. A cyclical pullback, on the other hand, is a shorter-term decline within the broader trend. It's tied to the natural ebb and flow of economic cycles. Think recessions, policy shifts, or temporary shocks like supply chain disruptions. These pullbacks can be sharp, 10-20% drops, but don't derail the secular bull. They're like potholes on a long highway, jarring, but you keep moving forward. For instance, the 1987 crash or the 2018 correction happened within longer-term bull markets. The key difference is scope and duration. Secular bull markets reflect deep structural optimism, often measured in decades. Cyclical pullbacks are shorter, typically months to a couple of years, and tied to business cycle fluctuations. In practice, you can have a secular bull market, say 2009 to 2020s in US equities, with multiple cyclical pullbacks like 2020 crash and 2022 inflation scare layered on top of it. Data backs this up. S&P 500's long-term average annual return, about 10% since 1926, captures secular growth, but it's littered with 5 to 10% corrections almost yearly and a 20% plus bear market every few years. The secular trend persists unless fundamentals like productivity or earnings growth collapse for good. Now, I just want to show you what a secular bull market is. So this is the secular bear market here, that move lower. A secular change occurred here, and then we went into a secular bull market in interest rates going up. This is your secular decline, and this is your secular bull market change for interest rates moving higher. The cyclical nature is the ones that you've got going like this, up and down. That's the cyclical nature of the move. So what people don't understand, and I hear it all the time, they're like, well, where's your commodity, bull market or your commodity super cycle? You're confusing the short-term upward and downward movements with your cycle. What I'm saying is we're going to get a big move in commodities up, but you're still going to get the short-term pullbacks in this cyclical pullbacks in the secular bull market. And that's where I think there's a big disconnect. And that's kind of, I'm just saying this because I see in some of the comment sections that that's what occurs. And this occurs, we'll see a slowdown in the SPX in my estimate, very similar to those cycles. This is the slowdown of each of those cycles, and that's what's coming in the future, in my opinion, is something over here, which will be a commodity bull market. The reason I think such is based off of the valuations going to extreme levels and the technical patterns that exist in everything. Bottoming patterns in commodities. We've got bottoming patterns in certain currencies. Commodity currencies are about to outperform the US dollar with some time. And that's all basically turning right now. And I think a big driver is interest rates, which has already broken its 40-year secular bear market low. So that's what I've got. That's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that special coupon code. We've got a 5 p.m. Mountain question and answer session coming up. Mountain time. Question and answer session coming up on Sunday. So I'll see you there. We'll catch you next time. This is Finding Value.